In our introduction to order flow, we went over the order flow theory and concepts, some of the longer term order flow tools such as the footprint, volume profile, cumulative delta and swing volume. So I'm hoping at this point you're comfortable with the information that these order flows tools present, why that stuff is useful, and how the various order flows differ. Now last week we took a look at how liquidity has an inverse relationship with volatility and how liquidity changes can drastically alter the personality of the instrument you're trading. And we took a look at locations to scalp off, and we had a look at stops as well, where stops would be, and that brings us to today. Now there's some commonality between the things that we've looked at so far, and that is that you can pretty much use everything we've looked at so far mechanically. So as in, you know, if A equals B, then do C. Now what we're going to look at today is something quite different. A look at using the order book and to an extent the tape as well, which requires the use of a reasonable amount of discretion and to some extent intuition or feel. Now there's a lot of people that are learning to trade that are convinced that trading should be 100% mechanical or 100% objective, and that at all costs they should avoid anything discretionary. Now they perceive the use of discretion as something that, you know, should be harder to implement than just a purely objective rules-based system. And then, you know, people go and spend 5 years trying to find the right set of rules or a combination of indicators that will give them a red light or green light system to trade off in all market conditions forever. Now there's no basis for this set of beliefs other than people really want trading to be mechanical. They want it to be a fixed set of rules because they perceive that to be easier. And I'm hoping today we're going to kind of shatter that myth and show you that discretion isn't difficult. It's not something you should shy away from. So today we're going to be talking about things that use a lot of discretion, but we're also going to talk about how to build your discretionary skills. So is this feel, this touchy-feely thing in reading order flows, some spiritual nonsense? Is it psychobabble? Or is it just the way that we actually do pretty much everything? Now this might be a little bit redundant because I think, you know, over the past few years more and more traders have got it. But for a long time I used to get 4 or 5 people a week coming to me and saying, oh wow, I've just discovered order flow, it's great. How do I program a system based on it? And invariably I've always tried to talk people out of doing that. So we're going to think about it, maybe think about it this way. If you gave a non-driver the rules for driving a car, they might think they could write a program to actually drive a car for you. But how many of you would trust that program to drive you to the airport? Now, I'm going to give you some background here. I'm an order flow trader, but I'm also a nerd. So I started programming when I was 13 years old, which is 30 years of programming, but even I wouldn't trust a computer program to interpret order flow for me, because essentially I would feel that whatever the program did, it would be a dumbed down version. Okay, so I'm a nerd, but I wouldn't trust a computer to trade order flow because effectively I think it would be dumbing it down. So it doesn't mean the fact it can't be programmed, it doesn't make it a higher skill, something only a genius could attain. It just means there's a bit of nuance in actually executing and reading order flow. So reading the order book and reading the tape are skills. And like a lot of skills, there's a learning process. Then there's a period of deliberate, conscious effort in execution before it becomes natural to you. So with any skill, you'll generally start off not being very good. Okay? Then with repetition, you're going to improve. And eventually, it becomes something you can do with a lot of conscious effort. Now, interestingly, once you have a set of skills and you're able to perform a task without a lot of conscious effort, thinking about it too much will actually make your performance suffer. So, for instance, take a golfer that is out playing with friends, having a relaxing round of golf, and not really thinking too much about what he's doing. He's going to be playing okay, going to be playing well. Then tell him to take a shot, concentrating on the position of his hands, where the ball is in relation to his feet, his stance, position of his shoulders, the arc of the club as he swings back. Chances are that if he's got all of that on his mind, he's not going to hit the ball as well. Because overthinking a skill that you've learned through repetition, for some reason, I don't know why, but it causes degradation in performance. Now also, we've got to consider the impact of performance when undue pressure is applied. So take the same golfer on a tee shot that he'd hit 90 times out of 100, and now tell him if he gets the ball in the hole, you're going to give him $10 million. Okay? All of a sudden, the chances that he's going to miss that shot have just gone up exponentially. And any Englishmen here will tell you that when push comes to shove, our national soccer team, when our national soccer team is in a position where they need to win a penalty shootout to qualify for a major competition, we almost always screw it up. Now, it's not that our guys can't score penalty after penalty in practice. It's just that when the pressure is on, we can't perform. So a lot of us has been there as traders or in other areas, seen our performance degrade in some area because we're thinking about it too much, or because we're under undue pressure. Now, for undue pressure in trading, that could be trading too large, or recovering from a few bad trades and trying to force it. Now, I come across a lot of people that have a bad patch, and their first bad patch usually comes after a decent run, and they go back to the drawing board because that bad patch continues. And the fact is, what they usually need to do is scale back a bit, chill out, relax, and just carry on doing what it was they were doing before, without this pressure they're putting on themselves because of this bad performance. Now, the point here is, there's a lot of things we learn in life that are skills we develop over time, and overthinking it or undue pressure will throw us off. So I want you to be open to the fact that certain aspects of trading are going to be like that too. Now, if you are an automation kind of person and you're saying, oh man, this guy's crazy, what I would say to you is at least develop your discretionary trading skills first. So anyone with a software background is going to tell you that, generally speaking, before you write a piece of software, you need some kind of specification. And with trading, the specification for automating trading is actually knowing how to trade. Otherwise, you're trying to attempt to automate something you don't actually know how to do in real life. Now, one other thing about discretion is some people equate discretionary trading to random shoot from the hip trading without rules. In fact, I know there's an educator in Top Step that was saying you need a trading plan, and somebody told him, well, Peter Davis doesn't have a trading plan, he just enters trades at random. I don't do that, it's not true. I have rules, and discretionary traders have rules. Having rules and using discretion are not mutually exclusive. Having rules and trading off areas that develop intraday are not mutually exclusive. So discretionary does not mean I don't have rules. Okay, so the lecture on discretion and intuition is over. So let's have a look at what prop shops do. And when I'm talking about prop shops here, I'm talking about traditional bricks and mortar prop shops, where they take in interns and actually give them an education. So they're not all the same. They don't all focus on the same set of techniques. Some prop shops are actually strategy specific. But generally speaking, prop shops will push traders towards order flow. And generally speaking, they will start people off on outright scalps and then move them towards spreads. And normally they start them out on thicker markets. So prop shops are generally getting people to trade off order flow. Now, their learning curve at a prop shop is quite short. So some traders, the better traders, get let loose on a live account, trading one or two lots after just 12 weeks. Now, saying that, some are still struggling at 12 months. The prop shops that I know about seem to be very lenient about the amount of time they give a trader to get it. But then again, most of them don't pay a salary. So there's a famous shop in London that pays about $750 a month to interns, which really would barely cover accommodation costs in London. So basically, the prop shops, a trader either gets there or leaves through starvation rather than being kicked out for being a bit slow. So a real glamorous job, that one. Now, if you want to trade like a prop trader, you have to be very focused and not divert or look for new techniques when it's going tough. This is a skill you're developing. You will not perform well initially. Now, sticking with it is quite easy in a prop shop. First of all, because you can have a mentor, but also because there's successful people around you, and you can usually see them at work. They might not talk to you, but you can actually see them working. Now, it's a bit tougher at home, because most people have got nothing but random guys on the internet to go for advice. So you might be getting advice from someone that doesn't actually know how to trade, but just sounds smart. Now, the tendency for retail traders is to try something new for a few days or weeks, decide it doesn't work, and then look for something else. So that's not approaching trading as a skill, but as a problem with a solution. Now, there's a lot of people online perpetuating the myth that it takes 10,000 hours to learn to trade, and that includes trading off the order book. That would actually be working full time for 5 years. So there wouldn't be any prop shops around if that was the case. So fact is, if you actually approach this right, and we're going to show you how prop shops train their interns shortly, you're going to see improvements on a weekly basis. You're not going to be seeing improvements on an annual basis. It's going to be weekly. You're going to start to make improvements quickly. Now, let's just take a look at the order book, and what I'll do is let me just bring up the screen so we can see it. So this is the jigsaw dome, or depth and sales as we call it. Now, not all order books are the same. So if you compare the most popular depth of market or dome on the market, which is X-Trader, and if you compare that to the standard Ninja dome, you're going to see a huge difference in terms of the information displayed. And prop traders, I know the price has gone down recently, but prop traders have been paying $1,000 a month for X-Trader dome for years and years and years, because of the additional functionality they have. So what I'm going to do now is I'm going to run through the columns on the dome. Before we do that, before I tell you what's on there, I've got to tell you that take note that nobody is reading and absorbing all of these numbers on the dome all at the same time. Okay, it would be a really big mistake to try and do that. And one other important thing to note is that the dome has got a lot of different components, and there's a lot of ways that you can use it. Okay, so we're going to talk about a number of things today, and you do not have to use them all. Okay, it's a bit like a chart. Every trader uses charts differently. Okay, and it's the same with the dome. People use the dome differently. Some people might be more interested in the flow of the upswings and downswings on the dome. Other people like me are more interested in the volume of trades hitting into each price. Other people might be more interested in the bids and offers and the spoofing. So don't get into the trap of thinking there's only one way to use the dome, and that is to be looking at and interpreting everything you see on there. Okay, so you could, for instance, be a trader who has a location they want to trade off and just look for absorption. Become an expert in looking for that, and for that to be the only thing you use to confirm trades. It's perfectly acceptable to use it that way. But I'm going to show you everything, but don't think you need to use everything. Some things you will find easier to use than others just because of the way your particular mind works. Anyway, so let's look at the components of a proper dome. So the first thing we have that we've talked about in excessively is the volume profile. So we've discussed that at length, how the profile helps us to see where traders are committed in the market. And then next is the market depth. So that's the inner blue column showing the bids and the inner red column showing the offers. So these are the limit orders, the floors and ceilings. These are passive traders with orders out there waiting for somebody to come and trade with them. Now inside here, the center two columns, the red and the blue column here, we have the market orders that eat the ceilings and floors. Let me just clear that down. So in this case, this is the current trades columns. Now, all decent domes have some way of showing you what's trading into each level. Okay. So in this case, the current trades column in Jigsaw, it just shows you what is trading this time round. So if we leave an area and come back to it, those columns will clear. Now, obviously, that's good just at an instant, just as a snapshot, but you might want to actually see what's traded, since the session started. So on the outside here, kind of this outer red text column, outer blue text column, the red one shows me what's been hitting the bid in total since the session started, and the blue ones show me what's hit the offer since the session started. So that's a little bit like, similar in concept to a footprint. You can actually clear that stuff down in Jigsaw. That's why it's empty. Some of it's empty there. So you've got the right here, right now view in the center, and then a total on the outside. And then finally, we have this weird looking column here with positive and negative numbers. And this is what we call the snapshot. And this is a view of the pulling or stacking to the ceilings or floors or to the limit orders. So pulling is generally referring to taking orders away or cancelling orders, and stacking refers to adding orders to a level. So right now we can see that since we moved to this price, we've got like about 260 contracts that have been added to the bid. We can see the inside offer here. Okay, we just moved down and 300 or so contracts have been added. So basically, it tells you if they're adding contracts to a level or if they're taking contracts away for a level. So right now, the inside levels, they're taking contracts away from the bid, they're adding contracts to the offer. Now, the order book serves three purposes. So for a scalper, this is all they need to enter and exit the market. Now, that doesn't mean before the session opens, they won't actually look at a long-term chart to see what prices are important. But basically, when it comes to entering the market, a lot of scalpers, or most scalpers, are just going to be using this information here. For longer term day traders, it's really about accepting, rejecting, or refining trades. So they'll first use some method of analysis to define a trade location. Could be volume profile, could be chart based, and it just comes down to having an area the market will either turn around or an area the market's going to break out from, basically. So for instance, chart analysis might tell you where the market will turn, but it's the order book that then tells you if that turn is actually occurring. And then the third purpose for the order book is actually staying in a trade, seeing if the order flow is on your side after you get in. So for people that hold on to trades for longer intraday periods, it's usually the first few minutes that need monitoring closely. So once you've got some breathing room in a trade, it doesn't actually pay off to be really focused on the order flow. Okay, you just use the order flow to get yourself some wiggle room or some breathing room in the trade. And that's it. So that's all the order book does. I'm expecting the market to turn here. Is it actually doing it? Is the order flow in the very short term supporting that premise? Once in the market, is the order flow still supporting my premise? Is the order flow on my side after entry? So it's not just an order entry tool. So how do these prop shops get their traders trading live accounts in 12 weeks? Now, bricks and mortar prop shops tend to get their traders to initially focus on thicker markets. So that could be the ES, US Treasuries, some of the markets on Eurex like the Bunu, the Euro stocks, the 6E currency futures. A lot of people start out with techniques for trading outright positions, but a lot of the traders do migrate to spread trading after they've learned how to scalp. Now, you can't just sit in front of the order book and watch it and expect it to make sense, not unless you really do want to spend 10,000 hours learning it. You're going to quickly lose focus because you've got really no idea what it is you actually need to look for. But the problem with telling somebody what to look for is that you're trying to describe something that is a living, moving thing. So you could read a description of what to look for and then go and try trading it, but you would really struggle. So somehow, any explanation needs to be turned into experience to be understood, theory into practice. So prop shops do drills. And these drills are fairly well known in the prop industry. And each of the drills itself has a specific point. It's trying to teach you something, but also it's giving you something to actually do whilst you're watching it in order to keep you engaged so that you actually learn. So some examples of the drills are here. So for instance, we've got this one, stay in the market all day. So that would basically have you entering a trade at the beginning of the day, and then the only thing you can do is reverse it. And the point being to keep you focused on the ebb and flow of the market. Another one, the two-tick scale, that's forcing you to focus very specifically on entry, over and over and over again, entering the market or getting the edge. Now there's this concept of getting the edge, and getting the edge, all it means is you enter a trade, and immediately after getting into that trade, it goes one tick your way immediately, so you're immediately sitting on a break-even or a winning trade. Okay, but only one tick. It's not like I'm getting a 10-tick edge immediately. So it's like for instance, I could buy the offer just before it ticks up. Now, random trading is just enter trades at random, but you're effectively then focusing on the post-trade order flow to see if it's on your side. And again, there's lots and lots of drills. You can look at the internet as well. There's lots on the internet, but these are certainly enough to start with. Now, some of these drills require you to be bidirectional, which means you're comparing one side with the other and weighing the two up. Whereas some of the drills are more directional, where you've already picked a side to be on and you need to confirm that side. And there is a difference. So for me, actually getting into a trade based on order flow is direction. In other words, you're very focused on confirming either a long or a short trade. Now for me, it would be really, really weird, and I wouldn't be able to do it, to just be sitting at a price and have my finger over both the buy and sell buttons, not really knowing if I'm going to buy or sell, but just looking for a trigger either way. So I find it difficult to be in long mode and short mode at the same time. Now I'm sure there are people that can do it, but I'm sure there's also plenty of people that use the order book and know exactly what I'm talking about. Now, on the other hand, once you're in, you have to weigh up the long and the short side to consider whether the order flows on your side or not. And it's a slightly different thing. Okay, so that's why you have to do drills that focus on both aspects. I'd say the very short term entering a trade takes a lot more focus than I'm already in the market, is it on my side? Now there's a guy called Guy Bauer who's the trainer at PropX, which is a prop shop in Singapore and Australia. He's got a YouTube page with some very interesting videos on it, including one that's called the cut and reverse drill. So that first link there is to the cut and reverse drill. There will be a recording posted, so you'll get those links. And you can see his video more on Guy's YouTube channel, so you can actually learn, see some videos actually recorded by the trainer at one of these prop shops. So I think that's a good thing to look at after the webinar. Now still, I think that what the prop shops do is pretty tough. I think it'd be pretty tough for someone new to the order book to attempt to spend 4, 6, 8 hours in a single day doing drills. I actually think it's counterproductive because of how people learn. So here is what I tell people to do at the start. Okay, this does work, but still lots of people ignore it because everybody's so keen to jump in and start trading the order flow, even though they've got absolutely no experience. And I can see that somebody's in there saying this is a very stressful way to trade. It will be very stressful if you jump in and try trading it without getting the experience. So I get people 2 to 3 weeks in saying it's just not talking to me, or tell me what I need to see. And I say, okay, did you do the drills? And they're like, well, no, I just tried to trade off it. So I say, do the drills. And they say, yeah, but can't you just tell me what to look for? And honestly, it's as if I'm actually trying to punish these people and not giving them the real stuff until they've paid their dues. And it's really not that. It's just that if you've gone through a certain process, we can have a discussion as peers. So unless you've actually spent 5 or 6 hours doing what I'm about to tell you, watching it without prejudice, it'd be very difficult to have a conversation with me about order flow. So there's two distinct skills you need to use the order book. The first skill you have to develop is the ability to read the information as it flows past. That's it. That is a skill, reading it. Now that is a totally separate skill from using the information to trade off. So diving straight into this and trying to trade off it, trying to analyze and interpret it before you learn how to absorb it is like trying to play water polo before you learn how to swim. In fact, if you try to use this in trading or you try to sim trade when you first start using order flow, you're going to build up negative feedback because you will fail at it. And that negativity is going to stay with you. Now, on the other hand, if you spend 6 hours doing what I'm about to tell you, you're going to make considerable progress. So here's what you do. First of all, you relax. You do not put any pressure on yourself. And that means no sim trading. Second thing is you enjoy this. And I'm serious about this. You put on your happy face. You sit down and tell yourself you're about to do something new and interesting because the fact is this is new and interesting. Third, spend no more than 90 minutes per session. Okay, so you're going to sit down in front of this and at 90 minutes or 60 minutes you're going to turn it off because after 90 minutes you're not really going to be benefiting anymore. It's because this is such a new skill. It's going to take a lot of focus and concentration at first just because it's a new skill. I can watch this all day with no problem. I don't understand how somebody can watch a chart after watching order flow for so long, because I'm looking at that candle and it is like watching an actual candle burning down. It's not really doing anything. Whereas I watch the order book and there's already something happening. But when you're new to this, you're not going to be used to it. It's going to give you a headache if you try and sit and watch it for 4 hours, and it will be counterproductive. Now, the best times to do these 60 to 90 minute sessions is just after the pit session open, just before the pit close, but not at really quiet times like lunch times. Now, these 60 to 90 minute sessions you can do 1 or 2 times a day, and you've got to turn all your charts off, alerts off, news feeds off, TV off. Basically, anything that might distract you needs to be switched off. And you're just going to focus on the dome, the flow of trades, the pace of the moves up and down, how easy it seems to move up versus moving down. Are there any prices that nobody wants to hit? Are there any prices it keeps coming back to? And the volume going through at each level. Okay, that's what you're going to focus on effectively. You're going to focus on the trades going through, but also try and get a feel for the flow. Is it moving through? Is it moving up fairly easily, but moving down as if it's moving through mud? Now, just watching this is going to show you a number of things that an explanation couldn't justify. You're going to start to see the absorption. You're going to start to see buyers fading away. There's no point me trying to explain it. If you sit there for 6 hours and do 6 sessions, you're going to see that basically. Now, after 6 sessions of this, you're going to make significant progress, and then you can start on some of the prop drills. You can start to bring in other aspects like looking at the bids and offers. You can start to dip your toe in the water of using this in sim trading or use it as a confirmation tool. And people are going to move forward much faster if they focus on learning to absorb the information first and then look at using it to make decisions once they can read it. And I'm not talking about 10,000 hours. I'm like talking about 6 hours, 10 hours, 12 hours, maybe 20 hours. Now, I'd also say for those that want to be more tape, time and sales oriented, it's exactly the same process. You're looking at exactly the same things as above. Now, as you learn this, stick with one market. If you can't do that, and there is really no reason you can't do that, but I have these conversations a lot with people, stick with one type of market, markets with equivalent depth. So, for instance, you could do Euro stocks in the European morning and then the ES in the US morning. So don't try and learn the order book for like ES and crude at the same time. The liquidity is so different. You would basically, one would negate the other in terms of the learning process. Now, if you're not sure which market you want to start with, then allocate yourself 3 or 4 days at the start of this, just watching the order flow in a few different markets, and choose one that talks to you. Now again, don't approach this with your serious face on. It's just an exercise. Relax, enjoy it. Don't sim trade it. Just look at a few markets and say, okay, I kind of like the way that one moves. I'm gonna now zoom in on that one. Now always look behind you. Okay, always look in the rear view mirror when you're reading order flow. If you don't look behind you yourself, or don't look back in terms of the market, in terms of the price moves, you're always going to set yourself to being a perpetual fader. So when the market's moving down, there's a tendency to look below you for the end of the move so you can fade it. But there's going to be multiple lines in the sand developed behind you that will provide ample opportunity to actually join a move and side with the overall momentum. So keep an eye on the rear view mirror, because that's often where the opportunity is. And I'm just going to, at this point, bring a chart across. I'm going to show you a big move down this morning. So this morning, we had this big move down, this big red line here. And these little red triangles are iceberg orders that are absorbing contracts on the offer. So the sellers were absorbing contracts on the way down. And this is what I mean about looking in the rear view mirror. Now, of course, there were some blue ones, there were some bids, but these were kind of counter trend. But on the way down, we had 1, 2, 3, 4, 5, 6, 7 major iceberg, or 8 major iceberg orders on the way down, which were effectively lines in the sand where the offers came down, started absorbing buying before the market rolled over again. So that's what I mean by looking in the rear view mirror, because you can just lean on those icebergs. Momentum's already on your side. You see the iceberg, you lean on it, market goes your way. Much easier to do than trying to figure out where this move's going to end. Okay. Now, also you can do is use a screen recorder. So you can record a whole session and replay the key areas. You can also play through a whole day and fast forward. Now that seems a bit of an odd thing to do, but if you do that, just play through 8 hours of market on fast forward, you will understand why it works well. You actually see that you actually get a feel for the momentum and the pace a lot better when it's on fast forward, and then you can kind of reverse engineer that when you're watching it live. Now I would say, if you're using Ninja, I would not advise you to use Ninja Replay. There's a couple of reasons, but basically the way the replay data is recorded, it's recorded in chunks, so it doesn't kind of move, doesn't have the same flow to it as if you're using a screen recorder. And also, as you start to trade, again, record your trades with Camtasia or BB Flashback, which is a free screen recorder. It's much better than using Ninja Replay. And also, with Ninja Replay, you can't just go back 5 minutes. You go back 5 minutes, it resets all your charts. Okay, so there's a lot of benefits. It's worth investing in Camtasia. If you don't have the money for Camtasia, BB Flashback seems to be the one that most of my customers are getting on with. Now also, look at the opening moves. The opening move in any market is always very interesting from an order flow perspective, because quite often there's an interesting order flow setup in the first minute or first couple of minutes. Now, I'm not saying you should trade it, but what you see very often is the market will open and it will get held at a price, and you'll just see a lot of orders hitting a price and it can't go through it. And quite often it coincides with an extreme or a step in the profile from the Globex session or an overnight session. But it's really worth watching that every day. So, if you're doing these 60 to 90 minute sessions, if you can include the open on that, it's a really good time to get an idea of the order flow. And also, there's an ebook that I'm going to give a plug, No BS Day Trading. It's about scalping treasuries off the order book and how to take advantage of some of the fun and games, the gameplay that goes on over there. Now, with that book and videos, you'll read it, and I guarantee you will think the guy who wrote it was smoking crack. You will not really understand a word of it, because that was my experience. Okay, if you're a genius, then that's fine. But basically, I read it and I'm like, well, I don't know what this guy's talking about. Then you actually watch the dome and watch the order flow, and then go right back and read it again, and then it actually makes sense what this guy is saying. So again, this guy's a scalper, scalping the treasuries, Whether that's what you want to do or not, it's really worth having a look at his ebook and videos. Plus, he does a free 100% refund if you're not happy about it. Now, we did discuss the 3 elements of a reversal previously. We're not going to go over it again, but just note that these elements of reversal are not mutually exclusive. You do often see more than one of these at a reversal. Now, the absorption and the seller's fade is going to occur at a low. And obviously, if you're seeing the absorption or the seller's fade, you're going to have an earlier signal and a better price. When buyers jump in, that is actually additional confirmation. Now, of course, when buyers jump in, price should move up. If not, you do not have your confirmation. What you have, if buyers jump in and price doesn't tick up, is you've got buyers fading a move and getting trapped. Now, it also helps to see these buyers jumping in are larger traders. So if you get 5 200 lot buy market orders, you should give that more weight than 1,001 lot traders. And that's where using the tape next to the dome comes into it. The only thing that's going to show you whether these big trades or not is the tape. Now, what you have when buyers step in, because you want to see buyers step in and price move up, what you're going to have is a poorer entry price. So with the order book and tape, you're going to have a trade-off between confirmation and entry price. So poorer entry price doesn't really mean poorer trade. It just means you've got additional confirmations as a trade-off. So with that, let's look into more details of the specifics of reversals. Now, reversals aren't going to occur necessarily at a single price, and nor will the signs of a reversal. In fact, on thinner markets, the thinner the market, the more prices over which a reversal is going to occur. So crude oil, for instance, will show signs of multiple iceberg orders being executed at successively higher prices before it reverses and turns over. So it's absorption, but over a series of prices. Longs effectively getting stuck on the way up. Now, gaming is very common. People using order flow to get other traders offside, but it's not necessary to participate in that aspect of trading. So it's enough to recognize that it happens and where it happens, which is areas lots of traders want to engage in the market, so major highs and lows. Still, the gaming itself is really just a variation of these elements of a reversal. Basically, getting people to trade one side, absorbing that, and then pushing the market the other way. So markets that won't be gamed are very strong directional markets. Nobody can actually step in front of that market, wiggle it around 3 or 4 ticks either way to kind of get people out of position, not if it's going one way. Now, the second entries or the pullbacks are less likely to be gamed because not many people are looking to enter there. So if you look at a major level, like a revisit to the daily high, you potentially have reversal traders and breakout traders looking to trade at that point. So you could push the market through the high and stop out the reversal traders. Then you absorb the buying above the high, which is the reversal traders exiting, and it's the breakout traders entering. After that, you can push the market back below the high, stopping out the breakout traders and really annoying the reversal traders that already stopped out. And that's why you see so many head fakes on markets like the ES, where it's ticking up through the high a small amount before reversing down. It's just gameplay. It's just people gaming the market. Now here's an example of a market getting thicker over a number of prices. Now I'm just going to explain what this is showing here. So this tool here is showing a summary of trades hitting the bid and the offer. So on the center here, this 25 here is trades hitting the bid, 0 is trades hitting the offer. It prints a new line each time price moves up, moves to a new bid and offer level. So a green line prints when we tick up, a red line prints when we tick down. The most recent action is at the top, and in this case we're just looking at 7 minutes of action from top to bottom. So if we look at this number on the right here, 10317, that's the delta. So we can see that in the 7-minute period, delta has gone down 5,000 contracts. So that's 5,000 more sell market orders than buy market orders. Price has moved down in this period 3 ticks. So I've got 69.50 at the bottom, 68.75 at the top. In the box, okay, we can see this box here, and to some extent this box down here, we can see it took successively more and more contracts to eat through the bids. Okay, so it happened below here, and it occurred again here. So we can see 578 contracts tick down, 329 tick down, 648, 975, 1410, 1411. Progressively, more and more orders being absorbed at each level. So this is the bidders gradually becoming more aggressive. So overall, the sellers are outnumbering the buyers. I can see the bid side, the sell market orders, the quantity is much, much higher than the buy market orders. But at this point, they're not really getting anything for their money. They're not really, they're not really moving the market much. Now, if you look at the chart, we can see that at this point, there is some contextual reason for a long trade. We're effectively coming back to the area we broke out from. But on the chart, there's nothing here to indicate the fact that the sellers are absorbing. Oh, sorry, the bidders are absorbing. So we just see on this chart, we can just see a market working its way down. The tape is showing us that the bidders are absorbing, effectively giving us a heads up that a reversal is in progress before it's visible on the price charts. Now, everybody wants to be a reversal trader. Okay. Well, actually, I wanted to be an astronaut, but second to that, I wanted to be a reversal trader. Now, momentum traders that use order flow are usually pre-breakout traders, but it's not as fashionable as trading reversals. So you might be tempted when you start to learn about order flow and you start to look at order flow and you start to read the DOM to focus only on reading order flow to look for signs that confirm it's a reversal. You might do your recordings and replay lots and lots of reversals to see what a reversal looks like, in which case you're really going to get run over a lot. Because you absolutely need to ensure that it's clear to you when a market has momentum, and you need to spend time specifically looking for that so you know what it looks like and you don't step in front of it. So for momentum, that's also, a lot of people would call that buying pressure and selling pressure. Effectively, it's the same thing. So for instance, we have 500 print at the offer, then we tick up, 800 at the offer, then we tick up, 700, tick up, pull back a few ticks on low volume, 650 at the offer, and we tick up. That's momentum, okay? But then when that happens, then you suddenly see 3,000 print and there's no tick up. That's a sign that momentum stalled, okay? So the point is, even if you don't trade momentum, if you decide you want to learn order flow and trade off order flow, it's essential that you're able to spot it, or what's going to happen is you're going to keep getting hit by it. You're just going to see a little pause in the market, kind of ignore the fact that there's a lot of momentum right now. You're going to get into trade and you're going to get run over. Okay, so spoofing, or the banana in the tailpipe trick. Spoofing is the art of putting orders on the DOM that you don't really want to trade, which is effectively making the floors and ceilings look thicker than they really are. There's a lot of people that say spoofing makes the DOM useful. Okay, so a lot of people say, oh, you don't use the DOM, man, it's useless, there's too many spoof orders. But spoofing is a risky business. So first of all, you want to try putting 2,000 contracts on the bid with your $5,000 account. It's not going to let you. So you have to have the account size to support that kind of order. And you might actually get filled. You might put 2,000 contracts on there. Somebody comes in and trades against that. You can't say, well, that was just a fake order. I don't really want those. So there's a lot of risk in spoofing. And there's obviously a reason that some of the largest traders are actually doing the spoofing. They obviously benefit from it. They wouldn't take the risk if they didn't benefit from it. So to me, the fact that spoofing on the DOM is one of the things that makes it useful, but admittedly there is a lot of gameplay involved, and it's not the most intuitive thing in the world. It would be great if you just had, wow, there's 2,000 offered there, 3,000 offered, market's going to go down. So whereas there's a lot of gameplay, and it just might not be your thing to try and anticipate what the games are, it at least makes sense to just be aware of what they're doing. Now, spoofing is inherently more risky in a thin market. So if there's only 10 contracts at a level, then putting a spoof order in when there's only 20 contracts in front of you is very risky. Spoofing on thin markets tends to be 4 or 5 levels out, whereas on a thick market like the ES or US Treasuries, it can be at the inside bid offer or one price away. So if there's 5,000 contracts in front of you, you've got time to get out of the way. If there's 5 contracts in front of you, you don't have that luxury. There's also something called flash spoofing, which is orders that just flash up and disappear really quickly. So you don't actually see much of this right now. It used to be quite common like 1 or 2 years ago. And it was allegedly predatory algos fishing for a reaction of other algos. But in any case, any order that just pops up, you might see it on the inside bid. You see like 600 contracts on the inside bid. All of a sudden, it goes 600, 3,600. And then 600, 3,600. And then you don't see it again. That's it. It's gone. And pretty much you can just ignore that. So the kind of spoofing we're looking for is the kind of spoofing that is obvious in terms of size. So basically, by obvious I mean if you're looking at a dome and every level on the dome is like 800 or 900, they're not going to spoof with 950. They're going to put 1,000. And if every level is 1,000, every level starts with a 1, they're going to put like 2,000. So spoofing is going to be obvious, and it's also going to remain for long enough where they actually convince people to trade contracts. So they're spoofing usually because they want to get out of the market and they want you to trade against them. But effectively, they're spoofing because they want you to trade on the other side. They want you to lean on that order. And you're not going to be leaning on that order if it's only there for a fraction of a second. So spoofing is going to be obvious and it's going to be there for a while. That's what you're looking for. Now, spoofing, large size on the bid, shouldn't be confused with an imbalance on the order book at the high or low of the day or at an area of support or resistance. We talked about this last time. So it's just a natural phenomenon that at the high, offers are going to be stacked, at the low, bids are going to be stacked, and the same for support and resistance. Can't read too much into it. So you focus more on excessive size at other places in the market. But one thing, it is significant if you return to a high or a low, if you return to the low of the day, and the market isn't imbalanced, if there isn't a lot more on the bid at the low of the day than the offer, that is something you should pay attention to. Now, forum discussions, internet trading forum discussions on this topic often come up with a common knowledge fact that markets always trade towards size, and that would just be fantastic. If the markets always traded towards size, we could have done a 5-minute webinar on order flow, because if that happened, that I'd just trade that. I wouldn't do anything else. You could just trade that, forget everything else we've discussed. So it's a bit more nuanced than that. So when you see excessive size on the bids and offers, what you need to look for, does that bid or offer shrink or move away a step as price moves towards it? Are traders shying away from trading as we move towards that point? So if there's a big limit order on the offer side, do we get close to it and suddenly nobody's buying? Is the offer effectively scaring buyers away? Third thing is what is happening on the other side. This is so important. Are there large offers making people sell? But on the bid side, there's all these people selling on the bid side, but actually there's an iceberg order on the bid absorbing all that selling. So that is one of the, if you think about it, if they're putting the offer on there to make you sell, they're going to be buying on the bid. So when there's gameplay like this, you'll find they'll spoof the offer, but sometimes nobody sells. People say, well, that's fake. I'm not going to fall for that. Then other times they do fall for it. And so the key is you don't always trade, if you want to trade the gameplay, the key is you need to actually see people fall for it before you go with a spoofer. So basically, you've got to look on the other side, see if people are actually falling for it, see if somebody's absorbing the orders. Another thing you want to look for, Does a reasonably sized bid behind you step up following a move up? So if you've got a bid 1, 2, 3 levels behind you, below you, like 1700, 1500 contracts, and as price moves up, that bid steps up behind you, that's a really good sign supporting an up move. On the other hand, a series of excessively large bids behind you that just come in, so instead of like 1700 that keeps stepping up with the market, you suddenly see 3000, 3000, 3000 at 3 levels below you. That's a bad sign. So seeing that 1500 lot bid stepping up behind you is supportive. Seeing 3 levels with 3000 lots suddenly appear below you, it's a sign the move up is over. A bidder is trying to generate enough buying so that he can exit. So again, watch the offer side for absorption when you see those excessive bids, but be aware that the drop can come away pretty quickly. So yeah, it's smart to look for absorption on the other side. When you see those 9,000 contracts come in, it might just be a few seconds before the market drops. So if you do see excessive bids below you and you don't have much breathing room in the trade, or if you're scalping, you really should consider just getting out and not trying to see how it plays out. If you've got a lot more room in the trade, obviously that's a different case. Now, spoofing happens all of the time, and certainly it's not as important as what is actually executing at each level. Okay, so orders are always being added and pulled. So when you tick up, so remember the liquidity vacuum, when you tick up, the bid has to build at that new level. So you're ticking up into an area where there's no bids. So don't think that that initial building the bid is significant. Okay, don't think, wow, they're all adding to the bid, I'm going to go long. Okay, and same on the offer side. When we tick down, you're ticking down into an area where there's no offers. So it's going to take a little bit of time, just 2-3 seconds for the offers to build up. So if we tick up or we tick down, you've got to give it a few seconds to let that level build, let the inside bid and offer build, and then once it's built, then you can look at what's changing to the bid and offer and say, okay, those guys are pulling out the way, those guys are stacking onto that level. So adding orders to a bid and offer over time at the inside bid and offer is what is significant. Now, to train your eye to this, you're going to watch the inside bid and inside offer, and you're going to watch a snapshot. Now, let me just bring that up again. There's a game called Which Tick Next, okay? And I'm going to predict that, silly as it sounds, I'm going to tell you that 70 to 80% of the time, you're going to be able to tell if the market's going to tick up or down next. Okay, now before you get all excited about that, you can't actually make any money out of telling whether the market's going to tick up or down next. So you're going to play a game called Which Tick Next, which is a drill, okay? And it's kind of one of my, it's a drill that I kind of invented. And it's simply waiting until such a time it's clear whether the market's about to tick up or down. So your 3 choices when you're playing Which Tick Next are: the next tick will be up, the next tick will be down, or undecided. Don't know. Some of the time you're not going to be able to decide. Okay? So, but from the times you decide if it's next tick's up or next tick's down, you should be right most of the time. Okay? And it's simply a matter of, right, if I look at the bid and offer now, I've got 380 bid. Okay, it's particular. I've got 450 bid, 100 offered. Okay? So we're going to watch that, and we're going to watch as the offer goes down. Okay, we can see as the offer goes down, we can say, okay, I can see the offer going down, I can see the bid still firm, therefore the next tick's going to be up. Or I can see the bid's pulling out of the way, the offer's going to be firm, the offer's firm, next tick down. So basically, you can watch the dome playing this game. You can also bring up the power meter if you're using Jigsaw, and this is a snapshot power meter, which effectively shows you red to say the bids are pulling and the offers are stacking, and blue to say the bids are stacking and the offers are pulling. But you can actually play this game, just sit there and say, okay, I've got 390 bid, 140 offer, nobody's trading it right now. So as soon as some as soon as some trades start hitting the offer, or as soon as the offers start to pull out of the way, then I'm just say up. And then I've made a decision, and you should be able to get that right 70 to 80% of the time. Okay? And it's really just about watching the inside bid and offer and just getting a feel for how it moves and how they, where are they stacked, where are they pulling. And if they start to pull from the offer, boom, it's going to tick up. Now, the last thing we're going to say about spoofing is there isn't really any benefit in showing your hand if you're a legitimate buyer or seller. Okay? So if you really want to sell 10,000 contracts, putting 10,000 up on the offer is going to risk scaring buyers away or having other traders front run your trade. So one of the big things about reading the dome is getting a price to lean on. So leaning on a price is where you say, I think somebody's selling there, so I'm gonna sell the price below it. Okay? So if you were a seller, knowing that, you really wouldn't want to put a large bid up if you wanted to get it filled. Now it does happen. Sometimes you'll just see a bid there for 9,000 contracts. It will go up to a 9,000 trade. Okay? So whenever you see large bids and offers, you're going to have to be wary of them because you've got to think, why would that guy show his hand? Okay? And that brings us to the end. So just bear in mind, the dome is a tool and there's lots of ways you can use it. Don't fall into the trap of trying to do everything that can possibly be done. If you just use it to spot absorption and you find that gives you the confirmation on your trades that you need, just do that. You don't need to get into all the gameplay and, oh man, there's this guy on the treasuries and I'm on the 5-year and he's on the 10-year and I think he's putting in a spread and all that kind of thing. You don't have to get into all that if you're just trading directionally. So, keep it in perspective and don't try and do everything because it's just like a chart. It's just a tool. And just like a chart, there's nobody that reads a chart and has everybody's method of chart analysis in their head all at the same time. So at that point, Eddie, I think we can answer some questions.
All right. Thank you, Peter. If you do have any questions, we are in the lounge. That's where we will be taking our questions. So please, if you can, join us in the lounge here. You do have any questions for Peter. And also, I did post, if you happen to be a first-timer here, we do have last week's webinar with Peter. It's the part 1, and today was the part 2. So any questions, please post those in the lounge. I'm just scrolling up here to see if we do have any questions prior. Let's see here. All right. Zermi123 had a question if there is a room where we can learn. I'm not too sure on that question, but I know that Peter joins us just about every day in the equities room, and we do have a prep, S&P prep that he does share.
Yeah, we don't have a trade room per se. We don't have a room that come and pay and watch us trade. But what we do the stuff. I'm using the Top Step room most days. We also have a chat room, a Jigsaw chat room, and we do talk about the action and what's going on, and I will answer questions. But mostly the educational material I do is all on the website for free.
Okay. APC has a question. Peter, what did the letters at the 74 level mean?
The letters at the 74 level. Are you talking about the chart there?
Probably most likely the dome that you had. I know you've got this week's high, this week's low. That might have been some of the letters or something.
Oh, okay. Yeah. I've got overnight high, yesterday's high. This is just like for me to put shorthand, just to put some text in. So basically what I'll do is I'll analyze the market. You see my pre-market prep, and then I'll put the levels on here. So it's just my shorthand, value area high, overnight high, yesterday's high. XXX, that's my secret formula. XXX just means that's where a lot of volume traded.
All right. Let's see, Al23, from earlier, Peter, would there be a way to determine if a pulled bid was a buy limit or a sell stop?
Yes. it's only a buy limit. You can't, stop orders don't appear on the DOM. It's only limit orders. And limit orders are always at worst prices. So that's why you don't see, limit orders above the inside bid, and you don't see limit orders to sell below the inside offer.
All right, thanks, Pete. Thank you. Al, IJK has a question. You seem to really be talking about scalping. I assume you have to make sure you stay out of trading during reports. What type of ticks are you looking for, say, in the S&P Mini and bonds?
Okay, yeah, this isn't just for scalpers. So basically, I don't scalp. I use this to confirm trade location. So again, I do my prep every day. This is where I think the market's going to turn around, and then I look for pullbacks. But I'm looking for, I scale out, so I'm usually looking at 4 ticks for my first target, and then 4 to 6 ticks, 4 or 5 scales after that. So I'm usually looking for 5 or 6 points. But effectively, what you're doing here is you're kind of using a scalper's entry to refine a longer term day trade. That's effectively what we're doing. But yeah, 5 or 6 points would be the most I usually get from a trade. I'm usually out of scales by then.
All right. Thank you, Peter, and thank you, IJK. Lamas says, so if the bid diminishes faster versus the offer, price goes up or down?
If they start pulling the bids and the offers are staying firm, price will go down. That's generally that's what happens. I mean, I'm talking about the inside bid and offer. Any one price, when they start pulling the bids, it's probably going to go down, most likely.
Okay. All right. Any more questions? We'll take any more questions here. Otherwise, Peter, I appreciate the time. Once again, we will be having this presentation recorded. We'll have the first part and the second part. And posted, we did have, if you missed the first one, we did have the link for that. I will post that once again. And see, last week's, here we go. I'll post that here in the lounge so everybody does have it. Let's see here. Okay, there we go. All right. I think that's going to be it, Peter. Peter, appreciate it. What time you got on your clock?
2:10.
2:10. Well, it's a late night for you,
Absolutely.
my friend. But thank goodness it's Friday.
Now, can I just say about the next webinar that we're going to do?
Oh, please do. I was going to ask you about that.
What we're going to do next, the next webinar, you've kind of got all the components here. What we're going to actually look at next is, okay, so how do I actually put this, use this stuff in my trading? How do I get from not using order flow to using order flow without screwing everything up? So it's about really how to say, okay, you understand what order flow is, now how we're going to implement it. Yeah, there's somebody asking a question, how would I describe my trading style? Position day trader, effectively. That's what I'd call it.
Okay. All right. If you'd like to check out Peter's website, there is the link also in the lounge. I'll put that in the Squawk Radio Room also. All right. Okay, great. Well, Peter, get some rest. I know it's very late. I know I'm not going to make it past 10 o'clock tonight, so props to you. But I know if I was sitting next to you at an establishment, we'd probably be just watching the sun rise, saying, why is this place closed?
Yeah, exactly. Oh, dear.
All right. But, Peter, appreciate that. Peter Davies, jigsawtrading.com. I'd like to thank all of our guests that came out. I know that they were waiting and asking for you, Peter, throughout the early morning trade, and we'd like to just say thank you very much for visiting us here at Top Step Trader in our trading community. And Peter, have a fantastic weekend. We've got Peter on every Tuesday and Thursday here at Top Step Trader, so if you want to hear more, by all means, join us. Okay. Peter.
Excellent. All right, thanks, Eddie, and thanks everybody for joining again.
All right. Thank you, Peter. You have a good one. Take care, and once again, have a great weekend.
Okay, great. Bye.
Take care. Bye-bye.